Hey everyone, and welcome back for another deep dive.
Yeah.
This time we're going to be looking at something that's probably on a lot of your minds, and that's retirement planning.
It's a big one.
Yeah, I know it can seem pretty daunting, right?
Definitely.
All this confusing jargon, conflicting advice, it feels impossible to know where to even begin.
Yeah, it can be overwhelming.
But don't worry, we're here to help you sort through it all.
Absolutely.
We're going to be drawing on insights from this leading academic textbook on personal finance and investments.
It's a really comprehensive resource packed with valuable information.
And it's more relevant now than ever.
Absolutely.
Especially when you consider that people born in 2002 are expected to live an average of 76 years for men and 81 years for women.
That's a lot of years to plan for.
It is. That's a whole lot of life after leaving the workforce.
Right.
Plus, we've got this whole global retirement landscape that's shifting dramatically.
Right.
The textbook actually uses the term demographic time bomb, which sounds a bit ominous, to be honest.
Yeah, it's a significant trend we need to be aware of. In Western Europe and other developed nations, we're seeing this rapidly rising ratio of pensioners to workers.
So more retirees and fewer workers to support them.
Exactly. And that puts a strain on those traditional support systems like government pensions.
So what does that mean for someone like me who's, trying to plan for the future?
Well, it means that relying solely on government pensions might not be enough.
Okay, so we need to be more proactive, take charge of our own financial destiny.
Exactly. You need to be more in the driver's seat when it comes to your retirement planning.
So where do we even begin?
Well, this book dives into the concept of time diversification.
Time diversification.
Yeah, it highlights how investing in the stock market, particularly shares, can actually yield surprisingly positive results over the long term.
I always get a bit nervous when I hear the word stock market.
I understand.
It seems so risky, especially when we're talking about something as important as retirement funds.
I get it. But check this out. The book cites a study by Barclays Capital. They tracked investments from 1918 to 1998 and found that £100 invested in UK shares back in 1918 would have grown to almost £420,000 by 1998.
Wow, that's a massive return. Was that just a lucky streak or
It's not just luck, it's the power of compounding returns over time.
compounding returns?
Yeah,
So basically, the money you earn from your investments is reinvested and earns even more money over time.
precisely. And it creates this snowball effect.
Okay, so the longer your money is invested, the more opportunity it has to grow.
Exactly, even with those inevitable ups and downs of the market.
So the key is to ride out those fluctuations and focus on the long game.
You got it.
Okay, but how do financial systems fit into all of this?
Good question. The book breaks down the functions of a financial system in a way that's really helpful for understanding your options.
Okay, I'm all ears, lay it on me.
So essentially, financial systems provide mechanisms for investing surplus funds, raising capital, and managing financial risks.
So it's like this complex web of interconnected institutions and markets.
Exactly, and understanding how these systems work is crucial for making informed decisions about where and how to invest your money.
Makes sense.
But before you jump into any specific investments, the book suggests a framework called CORE.
Core, what's that all about? Is that like a secret code for financial success or something?
Not exactly. It's more of a roadmap. It encourages you to consider your individual circumstances, like your age, your income, your existing assets.
Okay, so that's the C part. What about objectives?
Right. Objectives. That's where you define what you're aiming for.
Okay,
Whether it's buying a house, funding your children's education,
right,
or building that comfortable nest egg for retirement.
got it.
Those objectives are going to heavily influence your investment strategy.
And risk.
Risk. That's all about how much risk you're comfortable taking with your investments.
Right. Some people are happy to ride the roller coaster of the stock market, while others prefer a smoother, more predictable ride.
Exactly, and there's no right or wrong answer.
Okay, it's about finding what aligns with your personality and your financial goals
You got it.
and expenditure.
Right, expenditure. Understanding how your spending impacts your ability to save is a critical piece of the puzzle.
So it's all about keeping a close eye on my spending habits, I assume.
Precisely. The core framework helps you create a holistic and personalized financial plan.
This framework sounds really helpful.
Hmm.
But honestly, when I hear the word risk, my mind immediately jumps to losing money in the stock market.
Right?
Is that all there is to it?
There's actually more to it than that. This
Yeah.
book does a great job of challenging that common perception of risk. Have you ever considered the risk of inflation, for example?
Well, yeah, inflation is when prices go up, right?
Exactly. And that means the purchasing power of your money decreases over time. Even a seemingly small inflation rate like 2.5% per year can have a dramatic impact over 40 years.
Wow. So even if I'm diligently saving inflation, could still erode the value of my savings.
Precisely. Imagine saving up £100,000 for retirement, only to find that due to inflation, it can only buy you half of what it could have purchased when you started saving.
That's a scary thought, like a silent thief chipping away at my future buying power.
Mm.
Anything else I should be worried about?
Well, there's also income risk.
Income risk.
This refers to the potential for interest or dividend payments to decrease, which can be especially problematic for retirees who rely on those payments for income.
Hold on, are you saying that even safe investments like bank deposits carry some level of risk?
Absolutely. Think about the volatility we've seen recently with interest rates. Even if you deposit your money in a seemingly secure bank account, the interest you earn could drop significantly.
This is eye-opening. I never realized there were so many different layers to financial risk.
It's definitely more complex than many people realize.
Yeah.
And speaking of risk, I'm curious to hear your thoughts on this.
Okay.
Given the potential power of compounding returns that we've discussed, when do you think is the best time to start saving for retirement? That's a great question. Let me ponder that one for a moment. But first, I think we need to delve deeper into this whole investment thing. What are some of the key investment choices out there, and how do I know which ones are right for me?
Well, that's a great segue. This textbook talks quite a bit about shares and bonds.
Okay, let's talk shares and bonds.
All right.
I hear these terms thrown around all the time, but I'm not always sure I fully grasp the difference.
Yeah, it's a common point of confusion.
So break it down for me.
Okay, so in essence, shares represent ownership in a company. When you buy shares, you become a part owner, however small, of that business.
Okay.
Bonds, on the other hand, are more like loans. You're lending money to a government or corporation, and they promise to pay you back with interest.
So with shares, I'm betting on the company's success, hoping the value of my shares goes up over time.
Right.
With bonds, it's more about that steady stream of interest payments.
That's a great way to think about it.
So shares, potentially higher returns, but also higher risk.
Exactly.
Bonds, generally considered safer but lower returns.
So how do I know which one is right for me?
Well, that's where those individual circumstances, your objectives, your risk tolerance, remember that core framework?
Right.
All of that comes into play.
Okay, so let's say I'm relatively young, just starting out in my career.
Yeah.
I have a long time horizon before retirement.
Okay.
Does that mean I should be loading up on shares?
Well, if you have a higher risk tolerance and a long time horizon, yeah, hedges can be a powerful engine for wealth creation.
But what about someone who's closer to retirement? Should they avoid shares altogether and stick to the perceived safety of bonds?
It's not necessarily about avoiding shares entirely.
Okay.
It's about finding that right balance.
Yeah.
As you approach retirement, it might make sense to gradually shift your portfolio towards more conservative investments like bonds.
Okay, so reduce my exposure to risk as I get closer to actually needing to use that money.
Exactly.
This is starting to make a lot more sense.
Good.
I feel like I'm finally starting to crack the code of financial planning.
All right.
We've talked about the core framework. We've talked about these different types of investments. But where do I actually begin in creating a personalized financial plan? It all feels a bit overwhelming.
It's understandable to feel overwhelmed. Financial planning can be daunting, but this book offers a really practical step-by-step approach.
Okay.
And remember, even small, consistent actions can have a significant impact over time.
So what's the first step I should take?
Start by clearly defining your financial goals. What are you aiming to achieve? Is it buying a house, taking that dream vacation, ensuring a comfortable retirement?
Okay, goals first make sense. What comes next?
Once you know what you're working towards, you need to assess your current financial situation. Take stock of your income, your expenses, your assets, your debts. This will give you a realistic picture of where you stand.
It's like taking inventory of my financial life before embarking on this journey.
Exactly. And once you understand your starting point, you can start developing a plan to reach that desired destination, those financial goals you set for yourself.
That makes a lot of sense. But what about all the different investment options out there?
Yeah.
Besides stocks and bonds, there are mutual funds, real estate, so many others.
Oh.
How do I even begin to sift through all of that and determine what's right for me?
That's where the concept of diversification comes in. It's one of the most important principles of investing. Think of it like this. You wouldn't put all your eggs in one basket.
Right? No way. If I dropped that basket, I'd lose everything.
Precisely. The same principle applies to investing. By spreading your money across different asset classes like stocks, bonds, and real estate, you reduce your overall risk. If one investment performs poorly, the others can help cushion the blow.
So it's about not putting all my faith and all my money into any single investment, no
Exactly.
matter how promising it seems.
And diversification goes beyond just asset classes. You can also diversify within those classes. For example, instead of investing in just one or two individual stocks, you could invest in a mutual fund or ETF that holds a basket of stocks, further spreading your risk.
I'm starting to see how diversification can create a more balanced and resilient investment strategy. But does this mean I need to constantly be monitoring the market and making adjustments to my portfolio?
You don't need to be glued to the financial news 24/7.
Okay, good.
But regular check-ins are important. Diversification isn't a one-time action. It's an ongoing process that needs to be reviewed and adjusted as your circumstances and goals change over time.
So my financial plan needs to be a living document that evolves with me throughout my life.
That's a great way to put it. And as your life changes, so too should your financial plan. For example, as you get closer to retirement, you might want to shift your portfolio towards more conservative investments to preserve your capital.
Okay, I'm definitely seeing the importance of staying engaged and making sure my investments are aligned with my long-term goals. But how do I actually put all of this into practice? Where do we even start?
Well, besides the insights we've gleaned from this textbook, there are some practical steps you can take right now to start building a solid financial foundation.
Well, besides the insights we've gleaned from this textbook, there are some practical steps you can take right now to start building a solid financial foundation. Like,
Yeah.
give us the goods.
Well, first and foremost, start saving early and consistently.
Oh,
Even if it's just a small amount, that power of compounding will work its magic over time.
I know we keep coming back to compounding,
Yeah,
but it really is incredible, isn't it?
it is. It's like a financial snowball that just keeps getting bigger and bigger.
Exactly. The earlier you start, the more time you have for those returns to accumulate.
Exactly.
Okay, so start saving early. Got it.
What else? Another practical step is to create a budget and track your spending.
Ugh, budgeting.
I know it's not the most exciting thing.
But then
It's essential.
I get it. It's essential for gaining control of my finances.
Right. It gives you a clearer picture of where your money is going and helps you identify areas where you can potentially save more.
Okay, what else?
Don't be afraid to seek professional guidance.
Oh, yeah, financial
Yeah.
advisors.
Exactly. Financial advisors can help you create a personalized plan, choose the right investments, and navigate all those complexities of retirement planning.
Okay,
Remember, investing. It's a long-term game.
right.
It's about making informed decisions that align with your individual goals and risk tolerance.
So this whole demographic time bomb situation, it seems like it's making personal financial planning even more crucial than ever before.
Absolutely. Those traditional retirement models might not be as reliable in the future.
Right.
So it's really up to each of us to take control of our financial destinies and build secure futures for ourselves.
This deep dive has been a real eye-opener.
Good.
I feel like I have a much better understanding of retirement planning and personal finance in general.
I'm glad to hear that.
Any final words of wisdom for our listeners before we wrap things up?
Yeah, the most important takeaway is that it's never too early or too late to start planning for your financial future.
Okay.
Even small steps taken consistently can have a huge impact over time.
Compound interest.
Exactly. And don't be afraid to seek guidance from those financial professionals. They can be valuable allies on your journey to financial well-being.
Great advice. And for everyone listening, let's revisit that thought-provoking question we posed earlier. Given the potential power of compounding returns, when do you think is the best time to start saving for retirement?
We'd love to hear your thoughts. Keep in mind the journey to financial well-being. It's a marathon, not a sprint.
Right.
With careful planning, informed choices, and a bit of patience, you can absolutely create a bright and financially secure future for yourself.
That's a great note to end on. Thanks for joining us on this deep dive into personal finance and retirement planning.
It was my pleasure.
We'll catch you next time on The Deep Dive.